Going to the next product class, we're going to focus on our 5000 INV and INV DTI programs. These programs are not applicable to ATR. If you remember, I had mentioned that ATR applies to primary and second homes. ATR is not applicable to these INV programs. They are basically no income, both programs, no income, no employment, and no assets depending on the circumstances. When I say depending on the circumstances, obviously in the case of the purchase transaction, you do need to show assets to close. But on 5000 INV compared to INV DTI, you don't need any reserves. And under certain circumstances on the INV DTI, you also don't need any reserves. Please look at the matrices in order to get specific information regarding that. So these programs require, from a qualification standpoint, a borrower to be a homeowner. That doesn't mean that the borrower needs to have financing on their primary residence, but they need to own their primary residence. And you may ask, what does that have to do with anything? It simply relates to the compliance issue, whereby we don't want, as a lender, since these are non-ATR based loans, we don't want these programs to be used as alternative solutions for borrowers that have no other option for financing and getting into these programs for primary residence. There are exceptions made for borrowers that are currently not homeowners, especially when they're doing refinancing. In the case of a refinance, it's possible to consider exceptions to the rule of home ownership simply because it's very easy to get documentation showing where the borrower lives. It's easy to get documentation to see the rental, utility bills, credit cards, demonstrate rental income. There are other options that are available that are not available on a purchase transaction. If a borrower is currently renting and suddenly decides that they're going to want to buy an investment property, we have no way of knowing that they don't intend to occupy the property. So it's a little tougher to get into that. Tougher to get into a transaction like that and make the exception. There is also a foreign national component on our 5000 INV program. Again, very limited documentation on this. No income, no employment. However, we allow 75% on our 5000 INV program on a purchase transaction with 700 plus FICO score. We do allow that also on a rate and term refi, and 70% at 640 FICO score. All foreign national borrowers are limited to a max of 70% on purchase transactions on the same 5000 INV program under the 5000 INV FN program. First-time investors, meaning borrowers that have not owned an investment property in the last 12 months, are hit with a 5% LTV reduction. So if a borrower that owns their primary residence but has never bought an investment property but has a 700 FICO score, technically they would be eligible for 75%, but because they are a first-time investor, they would actually be limited to 70%. It's important that you study the matrices on this. Very simple program, very limited documentation, great program, and there's quite a bit of alternative these solutions for borrowers that would otherwise go for a hard money loan or hard money takeout loans. These programs are excellent for finding permanent financing. Quite often, hard money is only limited to 1 year or 2 years, and they need something long-term to continue the financing to take out the hard money loan. The 5000 INV DTI is looked at very similarly to a commercial loan where we're actually looking at the debt service coverage. Again, you will need to look at the matrix for the 5000 INV DTI, but the idea is that the rental income is going to service the mortgage payment, taxes, and insurance. So the DTI calculation is not based on our borrower, but it's based on the property. In the case of a purchase transaction, we're using the rental income from the rental survey. In the case of a refinance, we're looking at the rental income of the rental survey or lease, whichever is lower. Again, back to the prior conversations and the prior discussions of programs, different programs have tighter profiles. As such, they have better pricing. 5000 INV DTI represents a more aggressively priced program, but it has tighter guidelines. So the borrower that meets the profile of the DTI program will enjoy the benefit of better pricing compared to the regular 5000 INV.